Bang! Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem on how to properly record under the allowance method by using the percentage of sales. So if you're unfamiliar to the allowance method or percentage of sales, don't fret gang, I'll drop a link for you to get up to speed in no time. So with that being said, let's get it. So it tells us during the year of operations, Fall Wine Tour earned net credit sales of $311,000. Industry experience suggests that bad debt will amount of 3% of net credit sales. At December 31st, 2024, accounts receivable is $44,000. The company uses the allowance method to account for uncollectibles. Read the requirements. Okay, journalize bad debt expense under the percentage of sales, and how much will it be reported on the balance sheet? All right, gang. So first things first, we are dealing with accounts receivable, and we know one of the bad aspects of accounts receivable is that you may not collect on your money, i.e. uncollectability. So whenever companies have uncollectability, there are two ways to account for it: the direct write-off method or the allowance method. This particular problem is dealing with the allowance method, which means that companies estimate upfront a percentage that they are not going to collect. Once they estimate that percentage, they record the actual bad debt expense and create the allowance for uncollectible account balance. The allowance for uncollectible account happens to be a contra account to accounts receivable, which makes it reported on the balance sheet by calculating the net realizable value. Your net realizable value gain is simply just your accounts receivable gross amount minus the allowance for bad debt or uncollectible account. Basically, in other words, gain is just the amount that the company expects to truly receive and collect on the accounts. So with that being said, when you make the actual estimate, there are two ways that you can calculate that figure: either percentage of sales or percentage of receivables. And since this problem is dealing with percentage of sales, the easiest one of the two, we're going to rock and roll right now. So it tells us, journalize Fall Wine Tour bad debt expense by using the percentage of sales. Okay, gang, so whenever we're doing the percentage of sales, the title tells us just that. That particular estimate that we make must be based upon a percent calculated from previous experience of not collecting, of course, times the actual net credit sales. And so if we look at our earlier description, it told us that this particular company earned net credit sales of $311,000. And based on previous experience, the company estimates 3% to be uncollectible. And so in terms of making this particular journal entry, anytime that we make an estimate, we are recording a bad debt, which means that we're going to debit bad debt expense and credit allowance for bad debts. Some textbooks call it allowance for uncollectible accounts. You might hear me say it, but it's all the same, gang. It's all good. And so how are we going to calculate this amount? Simple. We're going to take the $311,000, which represents the net credit sales, and multiply it times 3%. That total amount of $9,330 will be the amount that's going to be reported on the balance sheet as the allowance for bad debt, as well as the amount that's going to be reported on the income statement for the bad debt expense. And so the explanation for this is simply to record bad debt expense for the period. We're going to check the answer. Bags all day. Next, they want us to show how accounts receivable is going to appear on the balance sheet at year end. We already know where we're going with this game. As I've said, your accounts receivable must be reported when you're practicing the allowance method at its net realizable value, which means that we're going to report the gross amount of our accounts receivable and subtract the allowance for bad debt account balance that we have. And so based on the early description, it tells us that at December 31st, year end, the accounts receivable balance was $44,000, gang. So we're going to put that in there. And we're going to subtract the new balance based on the estimate of the allowance for bad debt amount, which is $9,330, which will give us a net realizable value of $34,670. We're going to check the answer. Well done, gang. So there you have it. An easy breezy, quick example to display how to properly record your bad debt estimate under the allowance method when you're using the percentage of sales method. And so I already feel that light bulb is clicking your way, and since it is, hit the like button, smash the subscribe button, and share the channel with your friends so they can chase the bags too. As always, gang, I'm Dr. Who, and it's always my humble pleasure to have you guys share your time with me, and I will see you soon. Bags!